So when we looked at the title of this panel, which is about crowdfunding and venture building, I first want to start off with some statistics that actually came out this morning. So in 2016, there were 21 platforms launched in crowdfunding. One died. There were 79 campaigns that succeeded, and 17.9 million was raised. The question I would have is how much was spent on lobbyists promoting crowdfunding? On average, investors only came up with $833 per person, and the average fundraise was $227,000. And additionally, when you look at jobs creation, it was only 2.2 jobs per company. So I like to say I've been doing this now since 2000 in the venture capital industry, but really, you know, crowdfunding a couple of years ago played a very significant role in very early stage. But one of the things I'd like to address today is, you know, really crowdfunding versus the seed funds and the value that's added to the companies. So maybe we can just start with Markus and just come down the line and really talk about your view of crowdfunding versus seed funds.
Sure. Hi, Markus. Thanks for having me. So I don't really know how many actually crowdfunding campaigns are happening in fintech right now. I was wondering, is fintech really a space where you do crowdfunding? I mean, I know of Monzo, the UK challenger bank, who done crowdfunding campaigns. They raised £2 million, I think, in 3 minutes. But I wonder if there actually are many other companies right now. I think in general, crowdfunding makes sense if you speak to a C. I think if you know, consumers like it, you want to get some early traction, you want to get some evangelists in the space. I don't think necessarily that where fintech is heading into this B2B space, fintech is heading into infrastructure. Crowdfunding is not necessarily something where you get the right people on board because they probably don't understand what's it all about.
So Minerva, given your background and you know, as CTO of Gnirck, and additionally, you know, with a focus on AI and the blockchain, how do you feel about crowdfunding versus seed funds?
Yeah, I think that, you know, one of the reasons I joined Future Perfect Ventures is it is an early stage and seed fund. You know, New York City was actually where Kickstarter was created. You know, and crowdfunding is, to Markus's point, you know, a great alternative source of funding for certain types of things. I think when you're working on something much more capital intensive, and as a seed or early stage fund, you can provide the expertise that fintech companies who really need strong mentorship and advice to get into a highly regulated industry like, you know, like financial services. And that's the value that, you know, a very smart fund, you know, would have. And you have in a number of funds, including ours, you know, half of the investments are in blockchain, the other half in IoT and artificial intelligence. You've got folks who were your customers or your target customers who have, you know, a great deal of experience in this space. And that's the kind of smart money that startups can really benefit from, and not just, you know, money from, you know, from many, you know, 1,000 folks giving $10, you know. And so to me, that's far more important in the early stage fintech companies in particular.
And Ben, you know, your fund has a focus on IoT, which is a pretty hot topic for fintech, more on the B2C or perhaps the SME side. But maybe you can just discuss overall, because I know, you know, with IoT, how do you see crowdfunding has played a role and will play a role?
Well, I think crowdfunding does a very great thing for IoT, meaning most IoT companies have a device, have a actual product that they're trying to sell. And most of these times when we get involved is pre-seed. So they're still at the ideation and prototyping stage. So crowdfunding is a great way for the team to validate whether there is market demand and get feedback from their, you know, biggest supporters. On the other side, I think the difference between crowdfunding and seed funding is crowdfunding, when people give you money there, they want your product. And for a seed investor, we don't want the product, we want the business. So I think that's the core differentiation between these two.
And Gina, have you participated in any, you know, crowdfunding, have you funded any companies that were crowdfunded initially in the fund?
Not really. But I do see the potential for actually SMEs making use of crowdfunding platforms to raise money, because actually in Asia, a majority of the companies are SMEs. And they, instead of, it's not just for startups to raise funds, but actually existing companies to use it as an alternative financing platform. That will actually come in more handy. And being in the private equity and hedge fund space, I understand that there's a lot more small-size private equity deals that actually are overlooked by the bigger investment banks. This is a kind of platform that the smaller size deals can actually go through as well.
So before we get into really the role of seed funds in interacting with the companies, and we'll ask everyone on the panel, just a show of hands, how many in the audience actually believe that a seed investor talks to their companies once a week? Okay. Once every 2 weeks? Okay. Once a month? Never calls the company except when they run out of money. Okay? So I think on the panel, so just going back, we'll start with you, Markus, again.
Yeah, great.
So when you have a seed investment, what is the level of interaction that you have with the entrepreneur?
Well, I mean, it's, I guess in Asia you use a lot of WhatsApp and WeChat, right? So I've been very, that's where my microphone went out. No, fine. So I've been very impressed how, compared to Europe, you have a lot of WhatsApp conversations. So it happens really a lot that founders WhatsApp me at midnight.
Are they WhatsApping for advice, or they're WhatsApping for
business stuff? Private business stuff. So like about, do you know anyone to hire? Do you know anyone I can talk to? Do you know this kind of regulator in Malaysia or the MS in Singapore? How can we do this? I think that's where, let's try this again. Where we really, I think you have to be accessible and really help out the company. I think in general, you can call it venture builders, accelerators, incubators, seed funds. It doesn't really matter. It's different buzzwords at the moment. I think what we need is more operators. We need people who are mentors, investors, that really help the fintech or tech fin, the new buzzword, to really operate the company better. Because as you said, it's a very complex industry. And as more you help the company in any kind of stage, from seed to Series D or pre-IPO, you have to be part of it. And I think in our case, I can say, I've done Startup Bootcamp Fintech. It is like having 10 children, right? It's like having a kindergarten. You really have to manage well. And people called me the second wife, right? So, which is quite funny. And you are there all the time. Yeah.
We'll leave that one alone, Markus. So can you discuss, like, you run a seed portfolio? How active are you with your companies?
I think a great sort of, at least a goal should be, and of course, if depending on the size of the portfolio, you might have to divide it up amongst multiple advisors, but a good goal would be at least once. Don't let 2 weeks go by without a half-hour phone call with each of your founders. And good founders will also reach out to the investor, just a regular check-in. At a half hour, then it's very manageable, and they will prepare for that, or you can prepare and say, these are the things we're going to check in on. And if you need a longer consultative session, you can set those up. But at least have that check-in. Don't let 2 full weeks go by without the conversation. Too many things can go off the rails in that period of time.
And Ben, how active are you with your portfolio?
I personally try to stay in touch with our CEOs at least once a month. But I think it really depends on what exactly they're working on at that point in time, right? Sometimes if they are, prototyping one of their devices, well, we actually work very closely with them, with our manufacturing partners. So we're pretty much in contact every other day through emails, probably not phone calls. Sometimes if they're thinking about strategic direction, that's probably, a once a month thing. You basically understand what changed, why are they trying to take this company in a new direction, what resources they need, and you try to link them with people in your network where you feel they can add value.
Markus,
just maybe a thought here. Gina, want to say something first? So I think maybe a bit provocative right now, but I think we have to rethink the entire VC model a bit. The 220 model, as you know, sorry about this, I don't know, is so try this one. I think the model of a VC is really, I think, challenged at the moment, because the 220 model, you have the management fee, you don't have necessarily resources to really create.
It's Markus.
It's officially you, okay.
It's my German accent.
Try holding it like this.
Let's just maybe lean forward. I think that, if you look at the successful VCs out there, Sequoia, Axel, they have huge funds to really have management fees to create value, right? They have people in place that they can have 300 people to really work with the companies. If you are a small VC, you don't have necessarily the resources, because 220 is challenging you, that you cannot have people in place to really be with the portfolio. You invest money, how do you actually then have people on board, advisors, how do you incentivize your own team to really create value on the long run? And we set up Tryb, we thought about it very hard. So we're not a fund per se, because we are an investment holding company to operate like a company that is incentivized by the growth of the portfolio. So I think maybe, even though I love my VC friends, the model of the VC is also being challenged at the moment, where 220 is tough. Economics are really not anymore working out that well.
Well, I think I'll argue the other opposite side of this, but I mean, let's face it, some of the most successful fintech funds are Gnirck, which was founded by Hans Morris, who used to be running Visa. You've got Ribbit, which is Mickey Molka, who used to run Lemon Bank. You now have a new fund spun off by the guys at FIS. I don't think it's necessarily the fact that the LP-GP structure is broken. I think it's a question of focus, right? And I think what we've seen is only the very large funds, such as Sequoia or Excel or NEA, can really, be broad enough and then deep enough in each one of the sectors. And I think what you've had to see is that smaller funds have to pick a sector and have to be very focused, and you have to build a network. Because I think, as you mentioned, right, when these companies call you, it's about access. Yep. It's about building teams, right? And I think the question just is, for the very early stage, what will happen, right? We have not seen a lot come out of accelerators, right?
I heard rumors, yeah.
Yeah, we haven't seen a lot come out of seed funds. So what is going to be the model, I think, is the next question, right? Maybe, Gina, you're just entering this business from the asset management side. You probably think we're all crazy. But really, what do you think, as you see the venture market, especially in Asia, develop, what do you think is going to be the next model?
I think it'll be more adapted to the Asian context in a way that we try to see how we can value add to the company, how we can help them grow, not just in terms of providing financials and things like that, and actually getting them to the right doors. I think the access to the local markets or potential clients, that's very important. Yeah.
Ben?
Yeah, I'd like to add on to what Gina just mentioned, meaning she talked about basically providing value add, right? So we are actually also a small seed fund, but again, because we are small, because we are new, we have to focus, and that's why we chose to do IoT. Being based out of Taiwan, we have a lot of access to some of the globally renowned OEM, ODMs. These are the guys that produce, pretty much every single device you are holding in your hand right now. They work with Apple, HP, etc. Right? So for us, at the seed stage, money isn't always the most important thing for the startup, but rather the resources you can bring to the table actually outweigh the cash value you can actually give them. So from our experience, we've actually taken allocation away from top tier funds such as Sequoia, KPCB, etc., because the startup felt that we could add more value to them at that point in time, and they really needed that versus a big brand name VC that can give them 10, 20, $50 million. So I believe you really need to understand what your personal position is, or what the position of your fund is, how that relates to a startup, and what you can do for them. So our approach is actually to get very hands-on and help the startups build the businesses, at least to a point where they're ready for a Series A or a Series B, and then we kind of pass them off to the investors on those rounds, because there's additional resources that we probably can't bring to the table, but these guys already have on hand.
So to Markus's point, though, in Asia, the corporate investors have been very active. Actually, of all the capital raised, they've supplied 40%. So Minerva, when you're coming into a new deal at a seed round or a very early stage, how do you feel about having a corporate investor alongside versus another fund structure? Do you see a difference from your perspective?
Not so much. I think, right now we're getting a lot of interest from families. I think that's more typical in Asia in particular, families and family offices versus the corporate. So, for me, I think that makes a lot of sense from the perspective of working, with corporates, but also, accommodating the regional differences as we get funds, we have a global network, and having the flexibility to work both with corporates in the U.S. but also families in Asia is kind of where we can flourish. That way, we have the ability to, because we're small, we have a lot of flexibility in how we can manage our different relationships across the board, and then match them with the right kinds of ventures.
So let's shift a little bit to a slightly different question, which is we saw a period of time where a lot of the firms in the U.S. were going global. Sequoia was, in India, had moved to Singapore. They had offices in Israel. We've seen that with NEA, and we've seen it with other firms. They're now pulling back, and they're withdrawing from their foreign markets. And do you think we're going to go back to a period of time where venture capital becomes very localized again, with very, firms that are very specialized in their domain, in a geographical domain? Or do you think we're going to see more domain expertise, for example, like in fintech, and then specifically in certain areas like AI? What do you think, Markus?
I do agree with what you said. I mean, I think Sequoia, one of my co-founders at Tryb, he used to be at GIC in Singapore. So GIC is one of the oldest LPs in any kind of fund. So the benefit of that was to see the historical data of 35 years of LP of VCs. And VCs are the worst performing asset class globally, right? It is the case, right? VCs only return 5% IR normally in average the last 35 years. And I think that they've seen cycles of 8 years in the last 35 years of VC investment. I think we're coming to the close of, or the end of the 8-year cycle right now. Sequoia pulling out of Israel. I think you see India having some struggles. I agree with you that the tech field is becoming so fragmented. Tech becomes such a silo-driven industry that you need expertise locally with families in Asia. I think Asia is still very much family-driven. So to your point, every kind of family owns somewhere a bank or a brokerage firm or an insurance in the back, right? So how can you go through the top, not necessarily from the bottom up, to the customers? How can you reach scale through families who really, I think, have a conglomerate behind them that gives you the scale? That comes to the point, if you were to go to Indonesia or Malaysia, Philippines, it's pretty tough just to go there by yourself at the startup and do the bottom-up game. It's top-down, right? So again, I think that's where the game is changing, and people have realized you got to have the right LPs on board locally, not just globally.
Yeah, I think one of the things I learned as a quote unquote global CTO or APAC CTO was that Asia Pac is not a region. It's it's 17 different countries, 17 different markets, or 20 or 30 depending on how you count. And I think that where our fund has been able to combine the kind of global network with local investments, so companies like Arbor in the Philippines and BitPesa in Africa, right? But with California engineers and investors, as well as being based in New York, where a lot of the financial services are. And so, as you said, it's going to be a matter of focus. For us, I think one of the key things is with blockchain and artificial intelligence, there is a huge potential for efficiencies to be introduced to serve this vast number of underbanked and unbanked folks all over the world. And so, that's a lot of untapped, value and benefit that we think that others are, if you kind of take this global one-size-fits-all approach, it's not gonna work. And sort of having that hyper-local approach with a global network, I think will help a lot, and particularly in those emerging areas.
Well, Ben, I think you said it right. You've been able to extract allocation for the fund because of the value add. And I think it would be interesting to hear, specifically, how do you scale that afterwards if you end up doing biz dev for, a lot of companies in the portfolio?
I think, going back to what Markus just mentioned, Asia is actually very top-down, right? So I don't advise our portfolios to go into a new market and just figure it out. I believe what we do we invest in mainly US and Asia, less Europe. So we have portfolios out of US that want to come into the Asian market because the growth is here, but they don't really know where to start. So I think our job as investors and being based here and having better knowledge of the local markets is we should be able to identify which markets they should be going to depending on their business, depending on what's going on in that local economy, and who they should be working with there that can help them basically quickly move up the learning curve and understand how business is done. Going back to some of the items we just mentioned, I do believe VC is very localized by nature. Even if you look at the big American funds in Asia, in China, the teams there are local. You don't have American running the China office. It's a Chinese guy. So even if they're using the overarching brand, it's still a local team. And I think in terms of fragmentation, in the past few years we've seen explosion of micro VCs, and they're very, very industry focused. I think it's only when you get to the B stage, the C stage, where you have the big funds that are in multiple industries because they have that network.
So let's switch gears a little bit and let's talk about, in 2016, it was the largest year of financing for fintech companies globally. Asia actually exploded. But as we know, not every company that gets seed funding or a Series A funding is going to make it to the next level. So I think it'd be interesting to have the discussion of what you actually think a company has to achieve in fintech, which can be significantly more difficult to get from seed to A and then A to B. Maybe we can start with Gina.
I think it's important to work with a couple of strategic partners in order to scale up and to go to the next stage. It's not just about coming up with the product already, because I think there's a lot of it out there. It's more in terms of how it can be integrated to the larger game plan sort of arrangements. And being in Asia, and as many of them have said, the markets are very fragmented, so you have to understand the different regulations and the local needs and demands and how you actually sort of like customize the product to each market. Yeah, so that kind of thing.
So Ben, what's the metric you use for your companies?
I think for us, from C to A, it's mainly proof of concept, getting your first client or pilot going with perhaps like a big corporation. I think from A to B, it's more, you've proven the concept, but you're expanding the business rapidly. Usually it's going wide with the existing product or service that you've already confirmed from your client that works. And then you're just going out and going into different regions, going into different client bases. And further on, well, I think that's for another day.
Minerva?
Yeah, I think, especially, for example, something where we're very high in the hype cycle around AI, for example. For me, it's very important to look at specifics around the problem that's being solved and kind of at least a key customer is already using that technology and sees the value of it and is partnering. And that's sort of the interesting dance, I think, between, say, a bank who might be using AI technology, but maybe also developing their own version of it, or potentially looking to purchase that company. And that's sort of the space where, it's important to have that strategic guidance from the investor to help guide that company through those early days, because they might have something extremely valuable and kind of lose the thread if they jump too soon into a partnership.
Yeah, I mean, it might be a shock now, but we don't do startups. As 90% of our capital is, we do a mid-market PE, so we invest in 15-year-old companies that actually have cash flow. Actually exists out there that companies have cash flow. So we invest in, and you can't call it growth stage, could be Series D if you like. So we like to see the cash flow as more like tech vendors who actually are fintech, but they don't call themselves fintech. So we do 90% of that. We do 10% in kind of seed because we like technology, we like talent. I think in overall, maybe a second point is if you Series Seed or Series A, get strategic investment on board, because I believe the exit will not be $1 billion, it will be more acquisition of $50, $100 million by IBM or Microsoft. I think that acquisitions will happen more, trade sales are happening more. How can you be aligned as early as possible with someone that can buy you out at some point? I think that fintech will change, or like TechFin, the B2B will change towards acquisitions very soon because big guys are catching up. He will not disrupt the bank at all. He will transform maybe the industry. And how can you be then acquired for $50 million, which is a fair enough exit for a company? And so I think that Series C, Series A is really about product, technology, IP that then get acquired by an IBM or someone else. Yeah.
I guess I have this problem now.
Yeah.
I think that's an excellent point. There were only 3 IPOs last year, fintech companies. Yeah. And I think from expectation standpoints, the only investors who actually made money were Series A and Series B. The late stage investors did not make money because they had these wild expectations of what the public markets would pay. I think what we've seen is that the top out really, except if you get an extreme outlier, is 800 million on the acquisition side. More than likely, if it's a company doing well, it's about 250. And what we saw last year on the fintech companies that were sort of bought for technology, it was really $50 million exits. So I think there's a fair amount of reality. I think also when we've looked at least what it takes to get from A to B and B to C or Series C, we're seeing more like $1 million of recurring revenue that they can touch. And then if we're really to get to a solid B today, it's about 5 million of recurring revenue. And I think a lot of that does come from not revenue recognized, but it comes from building up the strategic base of relationships with the banks.
I think that the 28 whatever unicorns in fintech right now, the 78% of these have actually strategic, like Amex, Citi, they're all in there, right? I think so that you cannot scale if you don't have a partner from early onwards. I mean, I think all the big banks have now their VC arms, and every unicorn has at least some or 2 or 3 strategic in there, right?
Yeah, absolutely, a great point. Yeah. So we only have a couple of minutes left. If we want to take a couple of questions from the audience, I think we'd be happy to do so. Okay. Well, if we have no questions, I think one thing.
No, any
We've stunned you into silence. Yeah.
So next 2 years, what's the most exciting thing in fintech? We just go down the line.
To invest in? Or?
To invest in.
Oh.
We'll come back to you, Markus. Gina, you want to start?
I think it's not about just investing, but actually developing. So our angle is mostly in terms of the asset management and the pensions market, which we think that has a longer term kind of sustainability.
Great. Ben?
I like what the potential blockchain can bring to the table, and basically tracking every different kind of asset class. And we've seen a lot of interest with bank consortiums putting together a basic SOP for how this is going to work.
Yes. Minerva?
Yeah, definitely. Blockchain is, finally, I think, going to become a reality after years and years of hype. Having the information about actual pilots and things happening and turning into production now in various parts of, the major banks, as well as, the combination of AI and IoT and the kind of data that those things will provide. I think, and the data platforms that have yet to be invented to handle all of the IoT data that'll come off. I think that's super exciting to me.
Should I say AI now? Blockchain? Now, I think what I would like to invest in is different perspective. Invest in platforms that can run on assets. So I think if you look at the macroeconomic view right now, you see a lot of assets being shed by institutions. And I like to buy a portfolio of student loans, $500 million, have a platform to run on this. So it doesn't mean blockchain or AI. I think the real fintech, the thing that not really happens here, the real fintech is assets getting out of banks, getting distributed to new, owners. And how can you build platforms that can run these assets? That is, I invest in.
Great. Well, thank you very much. Give a big round of applause for our panelists.